Welcome to Advocis Coffee Talks. Please note that all attendee mics are muted and video is off to ensure that there are no technical difficulties. Your webinar will begin in 2 minutes. Thank you for joining Advocis Coffee Talks, espresso-sized webinars for Advocis members. I'm your host, Sheila Godsey, National Manager of Member Engagement at Advocis National. And helping in the background is Abir Sajjad, Member Engagement Associate at Advocis National. If you've just joined, please note that all attendee mics are muted and video is off to ensure that there are no technical difficulties. If you have questions during the presentation, please hover your mouse on your screen and you will see a Q&A button where you can type your questions throughout the webinar, and we'll make sure that all questions are answered before the end of this session. If you are joining us by phone, please email events@advocis.ca and tell us the phone number you joined from, first and last name, and Advocis ID. Our Zoom attendance report tells us how long each of you are on the webinar or call, and in order to receive CE credit, you must attend for the entire webinar. Today, we will hear from Charlie Conron, founder and CTO of Life Design Analysis. Charlie will show us how innovative technology can reveal hidden opportunities across the distribution channel, shorten sales cycles, and provide proactive solutions that can help advisors create satisfied long-term customers. Advocis is your professional association, and I want to take a moment to thank our partner association, Gamma International Canada, for helping Advocis continue to build a strong community of financial advisors across Canada. But first, I want to start off with a poll. I'm going to bring up a question and ask you to choose the answer that suits you. It's anonymous and no one can see who answered, including me. And here's the question. Do you call yourself a tech company or an insurance advisor? So the answers are tech company or insurance advisor. So just choose one of those. And it might seem like a strange question, but when you listen to the presentation today, I think that you will understand why we asked this question. So we'll give it another couple of seconds and then share the results. And here are the results. Well, there's two people on the call today who consider themselves a tech company. So maybe they're ahead of the game. And then the rest of you, 99%, consider yourself an insurance advisor. Interesting results. So let's get to meeting our speaker. Let me introduce our speaker. His name is Charlie Conron, and he is the founder and CTO of Life Design Analysis software. LDA is software that helps advisors communicate insurance solutions to their clients. And Charlie's background is in mechanical engineering, but his stepfather is a long-term advisor. So they started out trying to solve some communication issues with clients. And it soon became apparent that they had a great solution to research, present, and sell insurance. And in 2014, they transformed the software to a web-based platform. Take it away, Charlie.
Thanks so much, Sheila, and thank you everyone for joining. It's nice to be in front of an audience again, even if I'm presenting from my kitchen. As Sheila mentioned, I'm the CTO and founder of a company called Life Design Analysis, really a platform dedicated to insurance advisors, helping them search product, compare the product, but ultimately present it to their customers in a digital way that's a lot more meaningful. The other part of our business, which I'm going to be speaking on today, is the aspect of in-force policies. Sheila mentioned I got into the insurance industry a little bit by chance. I studied mechanical engineering in school, and I think it was my goal actually to design Ferraris. That's sort of, I was a car guy, and that's really what I wanted to do. When I got into the industry, I actually ended up designing air vents and seat frames at a magnesium die casting firm. So not the most exciting sort of work. But I was always sort of known as the computer guy at the company. My father was actually a programmer, and I've been coding since a very young age. So I always sort of got relegated to the tech side of the business. It was actually my stepfather, Larry Kinlan, who's a 50-plus year veteran of the life insurance industry. He was an MDRT lifetime member, top of the table. And he also thought of me as sort of his techie stepson and invited me into his office to see what technology could do for his life insurance practice. I'd also recently had a baby with my wife, Sora, and I sort of approached him and said, you know, if I'm going to understand and offer tech solutions, you've got to sell me some life insurance. And so, you know, he sort of gave me my different options, and I really saw insurance or life insurance from the consumer perspective, which, you know, initially was a lot of confusion. There's a lot of numbers, a lot of paper. The comparisons of these different illustrations were not apparently evident which product was actually best. And it wasn't until sort of the engineering side of me came out where I started to crunch those numbers and really see the value in some of the long-term products or cash value products the industry has to offer. You know, a lot of times we figure that it was people, you know, who are price sensitive, not seeing the value. So we took a way to basically take all that confusing insurance data and turn it into a visual picture. To basically show all of his kind of 700 clients who largely would be confused by their offerings as well, and basically compare visually, this is the path that you're on versus a new path. And it really worked. I mean, we started out, and he was not an insignificant producer, but we doubled revenue the first year and then doubled it again the following year, taking his FYC to over $2.5 million using this very simple concept of visualizing the insurance options. And we thought that, you know, the best place to start and the people that most immediately needed to see their options were these in-force policies, which again, largely were stuck inside his dated filing cabinet. And, you know, it really is, you know, sort of an opportunity for advisors. There's an old saying that you can see there: make new friends, but keep the old ones. One is silver, the other is gold. And it's something we learn in business when we started up on our own. It's something we're taught in business school. But a long-term customer is way more valuable than a single one, meaning it's a lot easier to retain a client, or a lot less expensive than to constantly be acquiring a customer. If you think about your own sales funnel as an insurance advisor, you might have sort of 50 prospects in mind. You get in touch with them, you might generate 10 qualified leads, and out of those 10 qualified leads, you might make 2 sales. And it takes time, it takes meetings, it takes lunches. There's an investment to acquire a customer, often referred to as your customer acquisition cost. Now, the insurance industry actually kind of struggles with turning these sales opportunities or service opportunities into sales opportunities because a lot of the information is actually kept from their reach and is invisible to them. So I'll run you through sort of a classic situation. So a client buys a Term 10 policy. The advisor gets the commission and moves on kind of to the next sale or the next prospect. About 9.83 years later, so as the product is almost finished and is going to jump up and increase in price, a letter is generated from a kind of a dated back office policy admin system. Now, many clients may not have heard from their advisor in years. They may not have even been thinking about their life insurance, but all of a sudden they get this letter out of the blue. You know, further complicate that, we get so much mail, so much junk mail, that a singular letter they may not even have time to look at it. It may get lost in the shuffle and never even seen. And advisors who are using sort of traditional CRM systems, they're not exactly programmed for insurance contract logic. You know, you have a Salesforce or CRM system, and you know, it's meant to tackle every different industry, but not specifically every industry, just the broad. So it doesn't actually have sort of the policy knowledge that insurance advisors really need. And the last point is, you know, timing may be terrible. If you think about, you know, March, April of this year, if you'd gotten your letter, even if you look at the example that I have on the right, there's kind of two main things. One, it came at December 8th, and this one's from 2017, and I blanked out sort of all the client details. But the other thing I like to point out is it was also canceled January 2nd, 2018. So it, you know, it's something where it immediately disservices the client, and our initial reaction is, let's cancel this. I'd like to take a closer look at this letter itself, just so we can kind of see the wording and put yourself in the position of a client again. You get this letter December, please be advised in accordance with your automatic renewal provision, your monthly premium is going to increase from $131 a month, something very manageable, to $932 a month. I mean, think about getting a letter saying your premiums are going to go to $1,000, almost $1,000 every single month. And if you have any questions, give us a call. Sincerely, the Client Services Division. So it's not exactly the best customer service experience for clients, and it doesn't really give them a long time to react. Now, this problem gets even more complex. Think about getting a letter like that every single year telling you your premium is about to go up. There's a big change in how term products are being priced, especially at that 10th year renewal. And I know the image on the right is a little bit maybe small on your screen, but it essentially compares a traditional term policy, which, you know, depending on the client's age, may have something like 5 points of renewal, right? They buy it at 40, 50, 60, 70, 80. You have 4 sort of dedicated data points. But with YRT renewal policies, after that 10th year, that policy is going up every single year. And again, it's something where we don't want to compound that client experience by constantly sending our clients, your rate is going to go up. But I think there's a huge opportunity for advisors to sort of reframe that discussion and actually turn it more into a sales opportunity. So, you know, we can flip that, and rather than saying, you know, your premium is about to go up, say, to prevent your premium from going up, here are your options. So today's customer really wants choice. And again, I've just thrown up some mock-up examples of that, that same sort of concept, right? Instead of just a simple letter that comes out and says, you know, your premium is going to increase, we've actually provided and said, you know, to prevent the increase of your premium from $100 and $130 a month to $900, here are some options you may want to consider. One of them was a reprice of the term 10, so a new product that they could purchase. One was a longer length term product, a term 20, and one was a permanent product, something that they could convert to. But the whole goal of these pilots were to actually retain the customer rather than them go back out to the market, that they would repurchase something, have time to react, and ultimately, again, we would retain that customer, keeping our customer acquisition cost lower. So we've done several of these automation projects at the carrier level and MGA level, and they're very successful at exposing that opportunity for clients. If you think about, you know, sort of this problem as you extrapolate it, really a successful advisor could have hundreds to thousands of clients. And if you think about Larry, he would have them over multiple decades of service, potentially serving up to 15 different carriers, right? So we're going to place business at all of these different carriers. And again, we're relying on a simple letter at all of these different carriers to kind of organize that information. When you extrapolate that across an AGA, an MGA, or an insurance carrier, you see how much business is actually riding on a dated piece of snail mail with literally zero marketing in play. I love how there's almost not even an attempt to service the client, just saying that they must contact us if they have any questions about their premium going up 10 times. You know, they likely will have an issue. And again, it sort of sends a mixed message if, you know, again, they haven't heard from the advisor. Now, really, when we think about, you know, the modern consumer, this is really an unsustainable client experience. And it represents an opportunity for advisors, MGAs, and carriers to capitalize by using technology like LBA to expose, unify this information, and really automate this service opportunity and essentially pick the low-hanging fruit. Now, if you think about it, life insurance has sunk to a 30-year low, according to the LIMRA 2018 barometer study. I found it very interesting. It said about 68% of Canadians households have life insurance. I believe that includes group as well. But what's really interesting is that those same people in that same study, 1 in 5 existing policyholders said that they would actually like to buy more insurance. So you think about 20% of your in-force policyholders have the appetite to up their coverage. If we're thinking about a term policy sold 9 years ago, what are the chances that that person has, bought a new house? Their needs have changed since that time. So, I mean, even if we take 2018's revenue, which like premium revenue, which was $117 billion in premium, if you thought about, 5% of those people wanting to buy more, that would be a $23.5 billion premium opportunity that is just sitting on the table there. And again, it's through the use of technology that we can actually expose the right information to the right people at the right time. And again, our technology helps solve that problem by leveraging those in-force data feeds, whether it's a KITS feed or a flat file from carriers. We bring it all into a unified location, and we use key data points like the policy issue date, the product type, to know exactly when that policy is going to renew. Rather than wait till 60 days out from that policy renewal, we set logic in place to remind you at things like the 7th year, the 8th year, the 9th year on that anniversary date, so that you can be proactive with clients, and the letter, if it should come, is not a shock, because we've said this is the path you're on, and these are the other options you can take. We've reframed that conversation. Now, we also marry that with current insurance quotes. So we actually, when one of those triggers comes up, we automate reports out for advisors so that they already have new quotes for replacement or exchange options. And this really helps insurance advisors, MGAs, everyone up to the insurance carrier generate more revenue from the existing block by retaining and delighting these customers rather than constantly having to reacquire a new customer, which of course is going to take time and money. Now, why is it hard to get access to this information? So again, one of the challenges when I coming from another industry, coming into the insurance industry, was, data wasn't always readily available or readily shared. A lot of the times we'll hear something like the legacy systems in place in the insurance industry are the problem. Now, they are part of the problem. We obviously need access to the information and a way to mobilize it, but they're not really a full excuse. Most advisors don't have a mechanism to get to the carriers, and they don't necessarily make it easy for advisors to get that information on the regular. Another sort of slightly blurring issue is that sometimes it's highly profitable for insurers when term policies actually extend past that guaranteed renewal. As soon as a term policy gets to its 11th year, it is the most profitable. And on the other hand of that, as soon as a term policy is lapsed without paying a benefit, that is also built into the pricing of it. So they're expecting a certain number of those to drop off. And as a result, insurance companies are not always motivated to surface these opportunities. Sometimes they are viewed as a cost. Now, organizing all of this invisible information can be a challenge, but it gets even more and more complicated as the succession in business goes on and older advisors are succeeded by their younger counterparts. We have this building transition of these blocks of business, but no immediate system that's going to transfer over, no CRM, no record that's going to come in and automatically have that policy knowledge of the contract so that the new advisor can go out and service it. So we really need technology to help us leverage this information and get it out there. And there really is a huge power of technology that's available to advisors. Now, at every level of distribution, technology is really transforming the sales profession. If you think about even how leads are generated, many of you may be on LinkedIn, on social media, creating conversations, and how you convert once that digital handshake is made. Oftentimes it's accelerating the amount of connections you can make, right? We can have thousands and thousands of connections on LinkedIn. by simply using an automated tool to go out and find prospects that meet our ideal clients. So it's really shortening sales cycles and bringing a new level of transparency to consumers at large. There's really no hiding from Google. Customers are out there using the internet. They're searching for policies. And they're looking for this kind of customer experience and transparency that they get from other commerce platforms they use. To a large extent, they're comparing the insurance transaction to that of what they do and get on Amazon. So, advisors really need to be proactive and acquire technology that can help them not only scale the reach in terms of their prospects, but also service the business that they have in force and that they get as acquire as prospects. So, really technology can give you that scale, and it provides proactive solutions that keep happy customers. We all know happy customers are sticky customers, something that the letter is not necessarily going to provide. The first thing we're going to think is, let's cancel that policy rather than what are my options? Now, the key really to any sticky business is to delight your customers. We know that from all of our favorite companies, our Starbucks, our Apples. They make the experience positive. They make it easy to do business with. So proactive service can turn that negative sales letter saying your premium will increase into options for that customer. But customers do want that transparency, right? They're going to go out, they're going to hide, they're going to search Google, they're going to check different advisors' websites. They're always going to be shopping for that best product that fits them. And I think advisors and incumbents really need to level up to keep pace with this evolved client experience and really think like a tech company, hence the kind of earlier poll. So I always like to give this example, and this is obviously if you've used Pizza Hut delivery, this is their online app for tracking your pizza. And you can see, we have technology to track something as insignificant as a pizza from the time that the order is received to when it actually hits the oven to when it's going to be arriving at your door. And you think about that a large amount of technology dedicated to the client experience for something as insignificant and affordable as a pizza. However, when it comes to something as important as life insurance, we're significantly underinvested in technology. And as a result, we're sort of blind to this opportunity. Now, when I give this example and I speak to advisors a lot of the time, I like to ask them, I say, are you an insurance advisor or are you a tech company? A lot of time I get the very similar results as our poll. 99% say, no, I'm totally a tech company. I'm in the risk business. And they sort of look puzzled at the questions in general. And I say, well, think about our example of Pizza Hut here. If I asked you, is Pizza Hut a tech company or are they a food company? I think most of you all would say the same sort of thing. Well, I order pizza from them. They're a pizza company, maybe occasionally wings. But by the same token, what if I told you that 46% of delivery and carryout orders from Pizza Hut actually come through digital channels? So that's nearly half of Pizza Hut's business actually comes from products ordered online. For them, that's $1.2 billion in online sales. And so, if I ask the same thing, are you a food company or are you a tech company? If you knew that half your business came from online orders, you would probably reprioritize that. So even if you're an advisor and you answered, I'm an insurance advisor, I'm not a tech company, I would say evaluate your percentage. Are you 20% tech company? Are you 50%? But consider that about 85% of people say they would use the internet in some way to purchase a life insurance policy. So whether that's going online, that's another LIMRA study, whether they're going online to research quotes, whether they're viewing your website, whether they're looking for informative content on LinkedIn, they're going to use the internet in some way to really demystify this insurance conversation. Again, if we remember, about 88% of them are confused. They really need that transparency and they're going to look online to find it. So we really need to level up when it comes to technology. Because, really the customer has evolved and we're really sitting on a golden opportunity to increase sales, delight our customers, and better fit their needs. But if we can't use technology to leverage and scale this vast amount of data we're sitting on, we really do risk losing these customers, whether it's, they cancel the letter and never come back, they start reshopping the market and go to a new agent, or even altogether new mediums. You know, we keep hearing about these B2C plays where all of a sudden when the customer goes online, they find a totally new way of buying insurance. So if we're not proactive, we really do leave and risk new players entering the market. You know, really the only thing standing in our way is creating a repeatable process around servicing these in-force opportunities and really investing in technology to do it. So, you know, really my one takeaway that I want to leave you with when you think about leaving today is, you know, are you an insurance advisor or are you a tech company? And how can you move that balance regardless of how you answered? Can you move it from 20 to 30? Because I think that's the way we build a sustainable customer environment where we're actually delighting our customers, you know, rather than creating a negative experience through our letter. So Sheila, I want to thank you. That's kind of the end of my presentation, but I'll pass it back to you for a little bit of Q&A.
Thanks, Charlie. There's some great ideas there. And I definitely think that insurance is a lot more important than pizza. So now we're going to get to our Q&A with Charlie. But before we do that, let's get to our last poll question. So the question is, now that you've heard Charlie speak, how important do you think technology is to giving optimal financial advice? The answers are very important. I am already incorporating technology in my practice, or important, I want to know more, or it's not my first priority. So we'll give it another few seconds and then we will share the results. And here are the results. This is fantastic. So 61% of you consider technology very important and are already incorporating in your practice. There's 34% of you want to know more and think it's important. And for 4% of you, it's not your first priority. So Charlie, I think that gives you a good weather vane of how the audience has reacted to your presentation. So we'll get right to the Q&A. So it's your chance to ask your questions and Charlie can answer live. So please hover your mouse on your screen and you should see the Q&A button where you can type your questions. And if we can't get to all the questions, we will post an email where you can reach Charlie after the webinar. So let's see what's come in so far. So the first question is, can a regular advisor take advantage of this technology?
Yeah, absolutely. You know, we sort of built our technology and we're very proud of that. We're sort of a from the field advisor built to advisor product. So anyone from an independent advisor, even if you're a career advisor, there's lots of benefit. I would say if you're interested in the software, absolutely try out our 30-day free trial. So you can visit lifedesignanalysis.com, sign up free. We have a 30-day free trial where you can actually put some of these tactics to use, see how that visualization helps communicate with your clients, and even load in your block of business to start seeing and surfacing some of those in-force opportunities that you can get working on immediately and fill your pipeline with. Great,
thank you. Now, somebody asked, do you think that carriers might actually want these contracts to expire so they can pocket the premium and avoid the risk, which could have changed over the initial premium timeframe?
Yeah, so I think it's a great question. And you know, a lot of lapse is certainly built into these policies. I think, you know, when insurance companies often acquire a block of business as well, they haven't necessarily done the underwriting themselves. So if you think of like AIG being acquired by BMO or something like that, they may not have been doing the underwriting themselves. It may have been another company that no longer exists, but they still have to honor those contracts. So, you know, there's certainly some element of risk in there, I suppose, to the carrier because, you know, there is a certain lapse rate built into there. But I do think the volatility of the term market, it's always better to retain that customer, keep them open to cross-sell opportunities, and, you know, sell them new products. So I think some of the hesitation is probably around conversions, but I think it's always better, you know, as long as you're an insurance company, you're in the business of selling them insurance. So to retain that customer and sell them a new product, I think is always valuable because it opens up the door to so many other possibilities and cross-sell opportunities as well.
That's fantastic. I have another question here. Is your software a database solution only, or does it incorporate CRM as well?
We don't sort of classify ourselves as a CRM. You know, when I think about a CRM, I think about email and marketing automation. I think of sort of a broad product like Salesforce or Agile CRM is another one, Sugar CRM a lot of people use. We do have a lot of those same elements. So again, when you think about all of that client and management, we can import every single client or prospect that you have in the system. We track all of that same sort of information if you'd like to keep a record of their phone numbers, their emails, their address. The one thing that we sort of say differentiates us, though, is that we're specifically built for policy knowledge, right? So unlike when you import your data into, say, a classical CRM, it's not going to have any knowledge that, let's say, you can exchange this term 10 to a term 20 before the 5th year, as long as your client's under 65. They're just not programmed to act like that. Whereas ours is specifically programmed around insurance policy knowledge and patterns to provide optimal opportunities when those service points come up. So even things like, client age changes, age nearest warnings, term 10 conversions, term exchanges, all of that, even being able to filter by face value in our system is all kind of what separates us from a traditional CRM. So I would say for some, we would be a replacement. For others, we would be a great complement.
Okay, thank you. In the interest of time, I'm just going to close off with one last question. Do the carriers actually allow you to tap into their feeds?
Advisors actually have the right to really upload anything to any system. So similar to uploading your clients into a CRM, you can request your block of business, and we actually facilitate that for advisors. So when we do it at the national level, we have data sharing agreements with our partners to release the information to us. But as an advisor, you actually have full right. These are also your clients. So it's really a big question. But when you think about this data, it really is mutual data. In terms of you value this client and view them as your client, and therefore it's your information. But they're also the insurance company's client as well, so it's their information too. But you do have a right to access it, and by structuring it and importing it into our system, that's a great way to leverage it. But great question.
Okay, yeah, I thought that was a great question. Thank you so much to Charlie Conron, founder and CTO of Life Design Analysis Software, for sharing his insights with us today.
Thanks very much, everyone.
Thanks, Charlie. So if you're interested in today's topic, you may want to check out a podcast discussion with the Advocis Technology Task Force that touches on key topics that financial advisors need to understand within the world of data security, fintech, and cyber insurance. It's free for Advocis members, and it's eligible for 1 CE credit. We will have those links in our follow-up email. And stay tuned, because on October 20th, our next coffee talk is with our own Will O'Neill, Corporate Communications Specialist at Advocis, and his talk is titled Lasting Impressions, Effective Writing for Advisors. Thank you for joining Coffee Talks today. We will be sending you a follow-up email tomorrow that includes a recording of the session and the links I mentioned. If you joined us by phone, please email events@advocis.ca and let us know what number you joined from, first and last name, and Advocis ID. CE credits will be loaded into your online CE tracker through the Advocis website and should be there by early next week. For more information, please visit our website at www.advocis.ca. And if you have more questions for Charlie Conron, please visit or email him at charlie@lifedesignanalysis.com. And if you want more information about Coffee Talks, please email events@advocis.ca. So let's find out who Gamma International is. Gamma International Canada is a partner association that exclusively caters to leaders in the financial services industry. If your role involves coaching and leadership, business development, training, or recruiting advisors into the industry, you would find value from being in the manager category with your Advocis membership. Advocis members in the manager category have access to Gamma and all its resources. If you're not in the manager member category and you would like to be, please contact Member Services. For more information about Gamma Canada, please visit www.gammacanada.com. Thanks again. Have a safe and happy day.